In this video, we're going to walk through an exercise that affirms your understanding of the concepts that we just went through. We have the same example that we've been working through from our prior example, that purchase price allocation exercise with that balance sheet that we went through. Recall that the original discussion showed a fair market value of PP&E going up to $400 million. Let's assume this is a stock sale, meaning assets don't get stepped up for tax purposes. And so the tax basis stays at 300. That's the assumption we're making. Let's assume that it's fully depreciable, so there's no land or salvage value. Let's assume both for book and tax purposes, the depreciation method is straight line, although that's not true. Most, for tax purposes, you'll use accelerated depreciation, but that's just going to complicate what we're trying to isolate here, which is the creation of the deferred tax on deal day. So let's just assume for simplicity, straight line depreciation, both for book and tax purposes, useful life of just a simple 2 years and a tax rate of 40%. I'd like you to take a stab at calculating. Let's assume that there's just cash revenues over the next 2 years forecast and no cash expenses. Super simple income statement. And so what I'd like you to calculate is the depreciation, the pre-tax profit, tax, and resulting net income over the next 2 years on the books that the target would show on the books, as well as what they would show on the tax returns. So give this a shot. Then we're going to go through it together. So hit the pause button and give that a try. It'll take you a couple of minutes and then we'll go through it. Okay, so let's go through this. The depreciation for book purposes is going to be 400 divided by 2 in each year. So let's identify 200 and 200 for both years. For tax purposes, since this is a deal structured as a stock sale, there is no revaluation, there is no step up to the tax basis. So we're looking at depreciation of 150 for each period. Again, we're doing the simplifying assumption where we're saying it's straight line for both book and tax purposes over a 2-year period with no salvage value. The pre-tax profit is therefore 500 in revenue. We're assuming, again, for simplicity, all cash and no cash expenses, just to isolate the thing that we're trying to look at, which means we've got pre-tax profit of 300. For book purposes for both years, and for tax purposes, the pre-tax profit is higher. Again, you don't get the benefit of that incremental depreciation, so you're showing higher pre-tax profit. You don't get any of the shielding effect of the higher depreciation that you would if the deal is structured, of course, as an asset sale. So for tax purposes, now the question becomes, with the IRS, you owe them, you're going to be recognizing a tax liability based off of 40% of the 350 on pre-tax profit. So 40% is going to be 140. 40% of 350 is 140, and that's what you owe in both periods, meaning that the sort of net after-tax profit is going to be 210 for both periods. Well, what happens on the book income statement? Do you show the actual taxes that you had to pay or the GAAP-based estimate for taxes? And the answer is you're paying the GAAP-based estimate for taxes, or you're showing the GAAP-based estimate for taxes. 40% of the GAAP-based pre-tax profit is not 140, but 120. So here you have this disconnect, and this is the critical thing. You have a disconnect between the book income statement and the tax income statement because of now this disconnect between the two bases of the assets. So the net income here is 180. You're showing lower pre-tax profit, therefore lower taxes than you actually paid. So this is what the two income statements look like. And now the question is, how do you sort of solve for this gap? To account for the higher future actual taxes, you see, this is on deal day, you know that you are going to now pay more in future taxes than under US GAAP you are going to show. Right? You're going to show a cumulative amount of $240 million worth of taxes for GAAP purposes, but you're actually going to have to pay 280 if you add these two together. To account for that higher future actual tax amount as opposed to GAAP taxes, a deferred tax liability has to get recognized on the acquisition date, the day that this revaluation takes place, in the amount of the total future differences. So let's look at the acquisition date balance sheet as well as the next 2 years impact on the balance sheet. Here I've laid out the original purchase price allocation exercise. Recall we had that $1 billion purchase price, and then we adjusted the target balance sheet on deal day. So these were the original adjustments before we sort of made the distinction between asset sales and stock sales. Here we have the exercise that you guys just completed, where we now have the income statement of, for book purposes, both in year 1 and year 2 going forward, and the tax income statement for year 1 and year 2. So what I'd like to do now is sort of revisit this balance sheet effectively by looking at how the PP&E write-up from 300 to 400, as we see that here, what the impact is. We originally identified the impact as sort of 100 going up for PP&E, so a debit to PP&E and a credit to equity. Well, in a stock sale, that's not exactly the case. So it wasn't exactly true the way we did it. It certainly would have been true for an asset sale, but for a stock sale, what ends up happening is, because we know that over the next 2 years, so immediately on deal day, we can sort of identify that over the next 2 years, you're going to be recognizing far less in taxes for book purposes than you are actually going to pay for tax purposes, because you get to benefit from this incremental D&A for book that you don't really get to benefit from for tax purposes, which is what really matters. So the cumulative amount of taxes that you're going to pay more to the IRS than you're actually going to show on the books is the difference every year of 20 for 2 years, or 40. That's recognized immediately as the creation of a $40 million liability, and so it's not a full 100 of equity that gets credited, but rather only 60. So the two together are what makes up the credit side to offset the debit on the PP&E side. Right. So this is the adjustment on deal date that actually takes place, and we can actually right away make the adjustment here. So what that would look like here in the original exercise is that PP&E goes up by the same 100, but instead we have this new line here of a deferred tax liability getting created at 40, and the equity becomes 60. And notice that this will actually create a difference to goodwill, because the goodwill is no longer 550, it's the excess of the purchase price over the 400 less the 50 in existing goodwill less the write-up to fair market value, not of 100 anymore, but of 60 because of that 40 million deferred tax liability. That gets us to now a goodwill that's no longer 550, but rather 590. And so goodwill actually goes up because the fair market value of the net assets doesn't go up by 100 when you adjust the fair market value, but only goes up to 40. So that's a little confusing, but you can see in this simple example, hopefully, what is actually going on. And so let's sort of revisit this section, which is what's actually happening to the balance sheet over the next 2 years. So if this represents the balance sheet revaluation on deal day, what happens over the next 2 years as a result of these deferred tax liabilities and as a result of these income statements? So let's take a look. So first of all, we can actually just look at the cash impact. On year 1, what is actually happening to cash? Cash revenues are 500. Depreciation is a non-cash item. Let's assume there's nothing else going on, just this income statement. Well, you have to pay 140 to the IRS, which means that what you actually get to put in your pocket is just the 500 minus the money that you owe the IRS. That's what's happening to cash. It actually is irrelevant from a cash standpoint what you recognize or what you're sort of showing from a tax standpoint on the book income statement. It's what you actually pay. So hopefully it's sort of pretty apparent that, let me just sort of zoom that in a little bit, is that 360 is what's going on to cash. The cash is going up every year by that 360. So I'm just gonna try to like this nicely here. So cash is going up by 360. Now what's going on to PP&E? Well, we're doing depreciation. These are, again, not to be confused, this is your book balance sheet. Your book balance sheet doesn't actually care what happens to your PP&E from a tax standpoint. It actually cares about your book PP&E. So book PP&E went down by 200. Oh, sorry, wrong row. Went down by 200 because it went from 400 to 200 and then another 200. So I'm just sort of looking at flows here, not balances. So again, these are all flows on the balance sheet, so don't be confused. So PP&E went down by 200, from 400 to 200, and then again from 200 to 0. So the PP&E is fully down, the basis is down to 0 during this period, while cash went up by 360 in each period. The deferred tax liability, let's actually get back to that in a second because that's probably the least intuitive one. Well, what happened to equity? Well, equity, that's a book basis question, right? Equity goes up by the amount of retained earnings on a book basis. So that's kind of the key disconnect, that you're like, cash is real, so you're actually identifying what actually happened to cash. But what happened to equity is just an increase of 180, which is what happened on the books. Right? So this is coming from here, and why not reference it? So we got 180 for both of these. Well, so at this point, do assets equal liabilities plus equity? You have a net debit on the asset side of 160 and a net credit of 180. Our model is out of balance. There's sort of the adjustments that have happened as a result of this income statement are not balancing, and the reason is because we didn't account for deferred tax liabilities. If on day one we recognize the deferred tax liabilities, the cumulative amount of taxes that you're going to pay in excess of what you're going to recognize in the future, that's why we recognize a liability. You're going to pay in excess of what you're actually going to recognize in the future by 40. Well, by the end of year one, 20 of that excess is already gone because you've already paid an incremental 20. So you're sort of looking at this year and you're going to say, oh, I've only got 20 left in liabilities, and another 20 is reversed until this 40 becomes 0. So when you look at sort of the end of this, the balance of the deferred tax liability is going to end up at 0, in the same way that the PP&E is going to end up at 0. So that is ultimately, and granted, a fairly complicated accounting for those that haven't seen this before, to capture the difference between the book and the tax bases of an asset during an acquisition.